So with our discussion about moving averages, we've been talking about the simple moving average, sometimes shown as SMA on a chart, the simple moving average. But there are other moving averages that you could use as well. And so there's a weighted, exponential, adaptive. These are the main categories of moving averages beyond the simple moving average. And they work in the same manner as far as like price crossovers and all that. But let's say you want a moving average that's more reflective of the most recent price. We know a simple moving average is an equal distribution between that price range. But it could make sense where you'd be like, I'm more interested in what's happening more closer, more weighted towards more recent pricing. So, you might think, well, I'm not buying 200 days ago. That's maybe too much of a lag. I'm looking for something a little bit more, and I want to use a weighting average that might take advantage of that. Now, a couple ways you could do it. One is you could just reduce the number of days in the simple moving average. That would give more weight to something that's a 10-day simple moving average gives more weight to 1/10 versus, let's say, a 50-day moving average where it's 1/50th. So you'd have more weight towards that more recent pricing, or more weighting really with all the pricing over that time frame. But you can also use moving averages that actually intentionally put more weight on more recent days. And that's what we're going to talk about here for some of the ways that you can do that, or basically moving averages that you can choose to use if you like to do that and want to put more weight on it, which makes sense as far as doing that. So the first one we'll look at is think of like a weighted average, right? And when we think about weighting averages, we could look at prices over, let's say, a period of time. Here's an example just from the math standpoint. This is over 5 days. You can see the prices. The furthest back price was $20 or rupees or whatever units you're using, and the most recent one is 31, and then there's a 33 there. So you can see, the more recent prices are much higher than the ones further back. Now the simple moving average, or the simple average on that, would be 26, right? You have your 130, add them up, divided by 5. Now a weighted average would put a weighting factor towards those numbers, basically. So the ones that are most recent would have a heavier weight to them than ones that are further back. So if we look at that first bullet point there, you can see the 20, say, dollars has a weight of 1, whereas the 31 has a weight of 5. And you do the math, 31 times 5, and you can see the math there, how that breaks out. And then you're going to divide that by you're going to break that out not by the number of days, but you're going to break that out by the weights, the number of weights. So it wouldn't be 5, because that would be a simple average, or you divide it by each of those weights, 1, 2, 3, 4, 5. If it was 20, it would go up to 20 different weights. And thus, mathematically, you would actually weight the more recent time by dividing 421 divided by 15. In this case, doing the simple math part, or the math part, would show that our weighted average would be equal to 28, 28.06 to be exact. Now here's the good news. You don't have to calculate any of that when you're trading or working with your trading platform. You just have to select that you want to use a weighted moving average as opposed to the simple moving average. But I thought it was important to understand that how it kind of works mathematically, that they are putting more weight on the more recent days when you do a weighted moving average. Another one that's very popular is an exponential moving average, where it puts even more weight to recent days. So the weighting given to the most recent price is greater for a shorter term extended moving average, or EMA, than for a longer period EMA. So for example, they might apply multipliers. So if, let's say, an 18.18% multiplier is applied to the most recent price data for a 10-day exponential moving average, then for a 20-day EMA, that would be 9.52 as far as the multipliers that they're using. Again, you don't have to calculate any of this. This will all be done automatically for you, but think that simple moving average is an equal pattern, equal weighting. Weighted moving average weights the most recent days heavier. Exponential weights the most recent days even heavier still than a weighted moving average. So if we looked at this on a graph, for example, we'll take our graph we've been looking at, our chart we've been looking at, and you can see I've got the moving average over a 50-day period. That would be a simple moving average. And I have an exponential moving average of 50 on there. So it's the same time frame, but you can see how they might differ as far as, in this case, they only differ slightly in terms of the price. Sometimes, and especially if you use different time frames, it could weight it even higher. But this way you can see as far as, the different weighting, or you could use a different type of weighting around that and weighting more recent prices versus prices longer back. You can even see how they even cross over at times too. Another one is an adaptive moving average, which is, kind of a push and pull aspect where it's looking at a short time frame to identify the beginning of trends quickly, and as long as necessary, you want to kind of construct it to avoid constant buy and sell activity or whipsaws. That's where these adaptive moving averages came in. Because with any of the other ones we talk about, you can still have that frequently trading whipsaws. So sometimes you might want to adapt it to a smaller number of days, and then sometimes to a higher number of days, but you can kind of play around with it. But you don't want to force it because you're not sure which is right as far as the right days. So adapting moving averages uses, calculations, complex, and it's all automated calculations to do this by detrending the series to make the current price most important. So it's not so much weighting as it's actually detrending, whether it's up or downtrend. It's actually adjusting the trend in the series of numbers is what it's doing with an adaptive moving average. So there's some complexity behind that. What you'll see on trading platforms, and probably the most popular one of this, is the Kaufman Adaptive Moving Average, or you'll see it listed probably as KMA, named after a gentleman named Perry Kaufman. And what it'll do is it'll closely follow prices when the price swings are relatively small and the noise is low, right? So it's kind of adjusting for that. And it's got a complex formula, a lot of multiple layers on it, and they actually have some recommended settings. Sometimes you can change the settings, but they have recommendations around those settings, for 10 being the number of periods, 2 the number of periods for an EMA constant, and 30 the number of periods for a slower EMA constant. Those would be the traditional numbers you'd enter in 10, 2, and 30. If you choose a Kaufman moving average in your platform, it'll actually prompt you for that. I have a link there if you want to really learn the whole math behind it. You can kind of find that out as well. So here's an image or a chart here where it's showing that the Kaufman moving average is looking that when prices spike there, it actually smooths it out even more, and you have that downtrend kind of coming down. And then when the prices turned up over 50%, then it really started to impact it more. I see is where it's weighting that more recent price changes versus an outlier. It's more weighting a little bit more of a longer part of that average with an adaptive measure is what it's doing. So with each of them, they all have their strengths and weaknesses. Simple moving averages would be the easiest to understand, and most commonly used. Weighted moving averages, they're weighting those most recent data. Exponential takes even more weight on them. Kaufman tries to use some more complex formulas around that, as far as, the different types of moving averages. So when you're looking at moving averages, that's one of the considerations you want to think about is which one you want to use. There's some other considerations too, which we're going to talk about in the next lesson.